What's going on, everybody? It's Brian Trippe. Welcome to another episode of the Alaria Masterclass podcast. This is episode number 90, and thank you for tuning in for 90 whole episodes. We've got a great guest that we're going to get to in just a second. Make sure you guys are checking out our real estate investing events, especially if you're local to our area. If you're in the state of Alabama, in the Birmingham area, or even if you're just driving through, we're always the second Thursday night of every single month. You can check us out on our website, alaria.com, or you can go to facebook.com/Alaria, ALAREIA. We have a great guest today. We've been talking about some apartments and how to build wealth through apartments here in the last, couple months ago, the past couple months. We've had Corey Peterson on. We've had Rod Cleef on. Now we have it blows my mind how much volume this guy is doing in such a short period of time, or at such a young age, I should say. We have Tim Bratz on. How are you doing today, Tim?
Doing great, man. Appreciate you having me here, Brian.
Man, I'm really excited to talk to you. You're a really young guy, man. How old are
33.
you?
Just turned 33.
33, and you are in. And I want you to kind of tell everybody what you've been able to accomplish in really kind of a short period of time, and at such a young age.
I get a lot of messages saying, "Oh, dude, it's amazing what you're doing, this and that." But the reality is, I started working and got in the real estate realm 9 years ago. I bought my first house, and I was doing contracting type stuff before that. And I was a real estate agent before that. And so although I've had a lot of success, especially over the past couple of years, it's just that snowball, that compound effect of really, shoveling crap for about 9 years. And then finally, last couple of years is when I start getting the attention and all that stuff. So I do want people to realize it's not like an overnight success kind of a thing. And it's been a lot of hard work, a lot of getting ripped off by contractors, a lot of walking through houses with roaches falling on your head and walking out and you have to strip in the parking lot because you got fleas all over your pants. And man, I've done all that stuff. But yeah, I got started or got introduced to real estate kind of going through college back in 2003 to 2007 is when I graduated. That's when the market was going gangbusters. Everybody was making money in real estate, wanted to make money, get involved in real estate. And so as a punk 21-year-old kid back then, I decided I wanted to get involved in real estate. So my brother was living out in New York City. I'm from Cleveland, Ohio, originally, which is where I live now. And my brother was living out in New York City, told me to come and live with him and find a job out there. So I became a commercial real estate agent and brokered different kind of like lease transactions for retail space in Manhattan. So wow. I remember closing negotiating a lease on a 400 square foot space in Greenwich Village. And the lease amount on 400 square feet was $10,000 a month on a 12-month lease with 4% annual escalations. And I remember thinking, this landlord's going to make almost $2 million over the next 12 years for doing something at one point in time. Right. And they're going to pay him $10,000 a month. He can go and blow through $10,000 and they're going to fill up his bank account again next month. Right. He's going to blow through it again. He can go fill it up again. And I was like, that's the side of the coin I need to be on, not brokering real estate. I need to be owning real estate. So I moved down to Charleston, South Carolina, sort of your neck of the woods a little bit, and bought my first house down there. Didn't have money, didn't have experience, didn't have the knowledge, didn't have any resources really, but I was resourceful. And I remember Tony Robbins saying, "Hey, if you're resourceful, you can find any of the resources. Resourcefulness is the ultimate resource." Yeah. And so I figured out a way to increase my credit card limit, got a balance transfer check from my credit card company, and I bought the cheapest house on the entire MLS, essentially on my credit card in Charleston, South Carolina in 2009, 9 years ago, and sold it 9 years ago this month. And so, didn't know what I was doing. I did all the work. I fixed it up. I did, the carpet, the flooring, the fixtures, the landscaping, the painting. Didn't know how to sell, so I just printed out some made-up flyers that I, handed out to all the different neighbors, held an open house. One of the neighbors came in and offered me about $15,000 more than what I was all into the property for. And I walked away in the worst, this is 2009, so in the worst real estate economy in 80 years, and a punk 23-year-old kid at the time, I had made, $14,000 after all closing costs in less than 75 days. Right. And was hooked. So did it again. And then, naturally you get into wholesaling. And then naturally you meet some people who have money, but maybe don't have the time. And I met some people like that. I did all the work. They put up the cash. And from that, we went into, flipping retail houses, like high-end retail, low-end retail, buying some single-family rentals. And then I fell into my first apartment building acquisition in 2013, bought an 8-unit building for real cheap, just couldn't pass it up, and just kind of learned the ropes. And then one of the things I did do early on, though, is I gave up a lot of equity, like 50 to 70% equity in my first probably 250 deals that I did. Because I realized I'm a punk 23, 24, 25-year-old kid, realizing not a lot of people are going to invest in somebody who doesn't have a track record. And so I had to give up a lot of equity in order to kind of build that experience, build that portfolio, and build that resume. And that's what I see a lot of people who are new to real estate not willing to do.
Right.
And they want to keep as much equity as they can. So it's a very scarcity type mindset versus go out and get some deals under your belt, get the reputation that you're somebody who closes deals, and you'll have more money flooding in, and then you can posture up a little bit more once you have that much more experience.
Sure.
So, yeah, man, just bought my first apartment building in 2013, and then in 2014, 2015, I kind of reflected back on my business and looked at where I was making, what I liked. Between the retail flips and the turnkey single family stuff, and then the apartment buildings. And I was flipping everything. So we would buy an 8-unit, fix it all up, tenant it, and then sell it like a turnkey apartment building, and then go roll it into like a 14-unit building, and then a 23-unit building, and then a 30-unit building. And I realized that, flipping houses versus flipping apartments, I was making about the same return when I flipped it. Like I'd make 30, 35% return on my investment. And, but when I calculated in the rents and the holding costs that were associated with that, I was actually doubling my return, almost doubling my return on the apartment side of things. Cause I didn't have the carrying costs and the holding costs and the stress of having to sell it pretty quickly. I could hold out for a good offer because I had that cash flow coming in.
Yeah.
And so I focused on that. And just kind of doubled down on apartments, had a bad partnership that went south. I had to liquidate about 200 units, but sometimes a setback is really a setup for something better in the future. And it allowed me to kind of then go out and do my own thing. And so for the past about 24, 36 months, I've just been building my own portfolio back up and building relationships with private lenders and taking a lot of the same strategies I use on the single family deal finding side. Just kind of guerrilla marketing and finding off-market deals, being direct to seller. And I've implemented a lot of those strategies into the apartment building realm. And, a year ago, I had about 400 units. And again, sat back, reflected on my business. Where am I spending my time? I built up another business where I was doing 100 turnkey houses a year, and realized that 90% of my time was spent on turnkey, but 90% of my wealth came from my apartments. And I'm thinking, what if I dedicated that time to building more apartment wealth? What could that look like? And about 12 months ago, I told my acquisitions team, we're not buying any more single family houses. Refer them all off to somebody else. And we're only focused on finding apartments. And when we did that over the past 12 months, we picked up another 900 units, a little over that, almost 1,000 units. And, today I'm at just shy of 1,400 units, like 200 under contract to close in the next 90 days. And actually might have another several hundred coming in this month. So I'm hoping to have about 1,800 to 2,000 units by the end of the year. And we'll be in a pretty good position.
Dude, that's an incredible story. Thank you for sharing that. And I've got a ton of notes I just took. And so a lot of questions that come off the story that you just told me. But just talk about, just before we kind of get into the details or the granular stuff, what kind of mindset shift does it take to go from all the single families to just, a year ago, it seems like you just said that a year ago there was kind of a switch that went off that, 90% of my wealth was with apartments. I want to focus on nothing but that. What kind of, that's a big shift in thinking to go from single family to multifamily.
A lot of people think it's a big shift. And what I've found is the more you make something a big deal, the more it is a big deal.
Okay.
If you don't make a big deal, it's not that big of a deal. And I find that in a lot of different things. And I found that same thing in apartments, and just setting the expectation with my team of saying, dude, we're doing the exact same thing as we did in residential. The only difference is now we're doing it with apartment buildings. You add an extra zero on it. And so commercial real estate it's a realm that a lot of people think they cannot get involved with until they go and stockpile a bunch of cash, right? Like, I need a bunch of money of my own in order to get involved in real estate. Or I need to have an MBA from Wharton Business School in finance or in real estate in order to get into real estate. Or I need some initials behind my name because I took some commercial real estate classes that makes me a CCIM, which I don't even know stands for. Or I got to come from generational money. My granddaddy had to buy real estate, then my dad, then I just came in and took care of I'm the third generation that comes in, and because my family has this big portfolio, I can get involved in commercial real estate because I come from money and it's easy for me to get money. That's what I thought when I initially got involved in real estate. And so a lot of real estate investors, they get involved in real estate because they want the residual income, the passive income. They want that mailbox money of filling up my bank account on the first of every single month. Let me go spend all my money and fill it back up. And then we get caught in this transactional, the rat race again. Yep. All we do is have a high paying job because we're wholesaling, we're doing retail flips. You do it once, you got to go do it again in order to get paid again. And what the mindset shift that happened was, you don't need to do that. Like, just like you raise 100% financing, 100% hard money, probably for your single family deals, I do the exact same thing for commercial real estate. I don't use any of my money for my deals. I raise private capital and I combine that with some bank financing. The difference is you can take an acquisition fee on the front end. So on a $2 million deal, you can take a 3-4% fee and take $80,000, $100,000 off the table on the front end, put it in your pocket. Now you have some capital to live off of while you're stabilizing the property. And then when you get the cash flow running, and my model is a little bit different. I know you talked about Rod Khleif. Rod Khleif's a good buddy of mine. Corey Peterson, another good buddy of mine. My model is a little bit different than theirs. In that way, they bring on investors, and sometimes they're buying stabilized assets, and they have a model to sell that property in 3 years, 5 years, 7 years. Mine's different. If I'm going to put that much work into a property, why would I sell it? Again, you're just going right back onto that hamster wheel of transactional real estate. Right. And you have to go do it again. You have to find another deal. You have to do more work again. So if I'm going to put this much effort into an apartment building, I'm going to hang on to this thing to build generational wealth, the legacy kind of wealth that we all think real estate has. That's how you do it. So my model is a little bit different. I buy heavy value add properties. I don't pay retail for anything. What's that?
Well, so I want to talk about that in a second. You're getting to a lot of stuff I want to kind of get to in a second. I definitely want to talk about value add.
Ramble. I appreciate
No. All good. I guess the point I'm trying, so I brought up mindset. You kind of corrected me where for you it wasn't necessarily a mind shift thing. It was more of just a pivot. You were just like, I'm doing all this and I see the value here. So I already have the infrastructure in place. So let's just pivot. Is that more like it was?
That, and you're not getting into a new realm. It's not like you're starting a tech company and you're not sure if you're going to be bought by Facebook or not. Like, this is real estate. It's been around since the dawn of civilization. And it's made more millionaires and billionaires than probably any other industry combined. So it's not like you're venturing into unknown territory. This is space that has defined wealth for hundreds, if not thousands of years. Sure. So it's real. You can get there. If other people have done it, we can do it. I think real estate's an equalizer of dummies. I know people with PhDs and I know people with GEDs that are on the same level, or sometimes the people with GEDs are more successful than people with PhDs because they simplify the business. And commercial real estate seems complicated, but it's not if you simplify it. I've taken it and I've taken everything that I've done in residential and I just rolled it into bigger apartment buildings. Yeah. That's it.
And you mentioned something earlier too, that these are my words, not yours, but this is how I interpret what you said earlier, is it's more of a marathon. Real estate's more of a marathon than it is a sprint. It's, you're talking about 9 years since, since you got into it. Just talk about what, you're doing all the turnkey flips, you're doing the retail flips, you're doing all this other stuff, the transactional stuff. So you understand it. Like you said, you understand real estate, but just talk about how it's important to build and be patient, I guess.
Yeah, big time. I mean, here's the thing. You screw up on an apartment building. I'll give you an example. This is an apartment building I just bought, and so I'm in this space right now where I have a team and I'm working on automating my team so that way I can just go focus on my unique ability. So I'm just focused on raising private money and doing a lot of marketing in order to get deal flow come in. Sure. And then I hand everything off to my team. So I've been letting my team mess up. What you need to realize when you're building a team is that they don't have the experience that we have. We've been in this for a decade longer. And they haven't gone through all the mess ups. And so, I let my team buy a 36 unit apartment building. I've never walked it. And they didn't go in every single unit. And because they didn't go in every single unit, we didn't know what each unit needed, the deferred maintenance that was going on. And we found that there's plumbing issues in every single unit. That's going to cost between $500 to $1,000 per unit on a 36 unit building. So now we're talking about $20,000 to $25,000 screw up that on a single family house, if there's plumbing issues, might cost you $2,000. Right. But on an apartment building with a screw up like that, it's going to cost you 10 times as much money. So, there's some things you got to make sure that you're looking out for, and you want to build the momentum maybe with some smaller stuff, or partner with somebody who's done it before. Meaning, you don't have to wait until you've done hundreds of single family transactions and gone through all those learning curves on single family. You can partner with somebody like me or Corey Peterson or Rod Khalif or somebody who's done hundreds, if not thousands of transactions and has gone through all those learning curves on their own, and they already paid for those mistakes. You can piggyback on them, because the thing about commercial real estate is we're not talking about a $200,000 house that you're going to make, $40,000 on. We're talking about a $2 million apartment building that you're going to make $400,000 on, or a $20 million apartment building that you're going to make $10 million on, because it's worth $30 million when it's all said and done. So I have a couple deals like that are going on right now where there's so much juice in the squeeze. You can bring on people who focus on their unique ability. Somebody can find the deal. Somebody can raise the money. Somebody's got the balance sheet. Somebody's got the experience. Somebody's the operator. And even if you have 5 people involved, there's more juice in 20% of a watermelon than there is in 100% of a grape.
Sure.
You follow me on that? You get that? So you can be creative. You can bring in other experts and not have to go through the learning curves in commercial. Totally. Kind of like you sometimes have to do on your own in residential. But gotcha. I think residential was a good setup for me in getting into commercial.
So do you think that's
cover all aspects of
for sure? Do you think that it's necessary for someone who's brand new to get their start with something like a wholesaling or something like a transactional type of thing, a one-off, a single family, before they start diving into a commercial?
It's hard for me to say that. I didn't even know that you could just pay somebody to sponsor your deals. I didn't know that. I thought that I just had to keep on trading up. So it's like one of those things, you don't know what you don't know.
Sure.
So now that I know, and I can educate newer investors of saying, hey, listen, you don't need the balance sheet. You don't need the liquidity in your bank account. You don't need to qualify for the loan. You can partner up with a guy like Tim, who can come in and sponsor the loan, get the loan, raise all the money for you, do all that heavy lifting that maybe you're not a good focus at. But if you're good at finding deals, if you're good at managing contractors and overseeing the ongoing management of the property, you can focus on that. Tim can focus on my stuff, and then we can partner up in the deal that way. So I didn't even know that world existed before, so I thought I had to take on 100% of it. And now that I know what I didn't know before, it allows me to then go and do bigger deals if I wanted to. Sure. So I'm in a position now where I can pretty much do any deal across the country. I'm looking at skyscrapers now. I'm looking at buying islands, doing some crazy stuff. And because I have the balance sheet, because I was able to build that up.
Yeah.
If I was looking at the Empire State Building, I'd probably need to bring on a sponsor. And there's people with more experience in real estate with bigger balance sheets than I have, that if I could go contract the Empire State Building in New York City and bring on a sponsor, I can be part of that deal. And somebody else makes a big part of the equity. I would get a big piece of the equity. And I know that I'm not the one who needs to have the entire balance sheet or have to bring everything to the table personally. I can partner up with somebody who has that experience, who has that net worth in order to do that. So it's it opens up a lot more doors once you realize that is an available option.
For sure. And I'd never even heard of that before until I was talking to Rod maybe a couple months ago. So it is interesting dynamic to commercial stuff because I was like you. I always thought that I had to trade up. I went from a 6 unit to a 59, and now I'm wanting to trade up to like a 250, but I don't have to do all that. I can take some other steps. So Tim, I'm a practical kind of person. I love, and I know you teach and you coach people as well. I'm a big, here's step 1, here's step 2, here's step 3 kind of, and I know we can't sit here and outline, how to go out and buy someone's very first, multifamily deal just on a 20 or 30-minute podcast. But what would step 1 be? If I'm brand new and I don't really know anything even about real estate, and you just got done saying that it's not necessarily true for me to go out here and do a lot of single family stuff, what would you advise me to do?
I'd become a ninja at one thing, and that's probably in this market, finding deals. In any commercial transaction, you need 2 things. One is finding money and finding deals. Okay. So if let's say you're very well respected in your community, you're a white collar professional, you can go raise hundreds of thousands, if not millions of dollars from other white collar professionals and business owners and entrepreneurs. Like, you can go and take equity in different deals just for helping operators like me go and raise money. Sure. That's one less thing I have to do. So you can go and raise money, and I would give you equity in that deal because you helped me raise the capital for that. Let's say you're not that influential and you can't raise millions of dollars of private money. Maybe you can go out and find deals. That doesn't cost anything. All it does is take a good work ethic. And especially in this economy where it's harder to find deals than it was 5 years ago when you could just buy apartment buildings off the MLS, when the market gets stronger and hotter, you have to go backwards towards more rudimentary methods of finding off-market deals. So that way you can find off-market, be direct to the seller. Then you're not getting into bidding wars with other investors. Yep. Then you're not dealing with brokers and all those headaches. So if you can find off-market deals and be direct to the seller on those deals before anybody else can, that's a big value in this marketplace. So just like you're looking for motivated sellers in the residential realm, look for motivated sellers in this commercial realm. So how do you find motivated sellers? Who's a motivated seller? I don't know. Just like there's, the 4 Ds, death, disease, divorce, disaster in single family. Those same things exist in a multifamily. Somebody in Birmingham, Alabama, in Charleston, South Carolina, in New York City, in San Diego, in Dallas, Texas, in Miami, Florida. I don't care what market you're in. There's deals out there. Somebody has to liquidate their apartment building before they can finalize their divorce that they're trying to desperately get out of. And they're willing to take a discount on the property in order for you to come in and help them out of that situation. So there's that situation. Somebody's inheriting a property and they're an artist in New York City and their grandpa was a wealthy landowner and they want nothing to do with owning apartment buildings or managing apartment buildings, and they just want to be able to go and paint pictures the rest of their life. They're willing to take a deep discount to just liquidate that and not have it on their plate, so they can go do their free-spirited stuff. Yeah. So there's that going on in every market, sure, regardless of where you are in the country. So when people are like, oh, there's no deals in my market's too hot. BS. Finding good deals is a mindset. It's realizing that there's a deal somewhere. It just needs to be found, and I want to be the first person to find it. And if I look at deals for 10 hours a day for 7 days, I know there's a deal coming up pretty soon that I'm going to be able to look at, make an offer on, and move forward on. So just the same thing. Look for motivated sellers. What's a motivated seller in the commercial realm? You own rental property. When are you the most upset with your tenants or with owning rental property?
Yeah, no, for commercial, because I own a 6-unit commercial building and my parking lot needs to get paved. And that's something I feel like is really simple. You drive through maybe even an apartment complex and the gravel, or it's all torn up. The parking lot's all torn up. Well, if they're not fixing that, there could be some capital issues there. There could be some distress there.
So the 2 people I buy most of my properties from, I'm looking for distressed situations. Mm-hmm. Typically, it's either physically distressed, like you're talking about, mm-hmm, or from a management perspective, distressed. Mm-hmm. So from a physical distress level, it's usually mom and pops who've owned the property for a long time that are self-managing it, and they're living off the cash flow. They're not reinvesting any of the cash flow back into the building. They're physically doing the work because that's their salary. That's how they're making their money. And what happens when you do that and compound that for 20 years, if you don't make any capital improvements to the building, eventually you get into that position where now you can't afford to go do a parking lot, to go do the roof, and you're backed into a corner where they have to sell. They have, because they're restrained by capital. So that's a big deal. Secondly is tired landlords, just pissed off because the tenants aren't paying rent. You're going through eviction. You didn't collect rent for the past 2 months. Now I got to pay an attorney to go see through the entire eviction process. It's hundreds of dollars. Then they're going to get another 30 to 60 days in my property rent-free. Then they're going to get kicked out. And then I got to spend a couple $1,000s in order to turn the unit over. And then I have to pay a leasing agent. And then it's going to take another 30 days to lease it all out. Like, I'm not getting paid for 6 months, and I'm coming out of pocket thousands of dollars. Like, that's a very motivated seller in the commercial realm. So go hang out at eviction court. Go talk to real estate attorneys. Go talk to property management companies. Yeah. Talk to the landlords down at eviction court. They're like, I'm tired of this business. Da 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 da. So that's another kind of tired landlord. And then management distress. So I just bought a big portfolio of properties, your neck of the woods, just outside of Atlanta, Georgia, from 2 Wall Street brokers. And these are Wall Street making a bunch of money and smart guys. And then they think, yeah, I'll go throw some money into real estate. So they go and invest in real estate. They have no experience investing in real estate. It's like buying a restaurant without, just because you eat in a restaurant doesn't mean you know how to run one, right? Yep. And so they buy apartment buildings. They don't have a local partner overseeing the management of it. They don't know how to interview a property management company. So the property management company nickels and dimes them, takes a bunch of their money, doesn't put anything back into the property. They're cash poor now. They can't put anything back in. And they take their eye off the ball in their primary business. And eventually they're just like, I either need to let this thing go or both my businesses are going to sink. And so they dump it. I was able to buy 730 units for $9.5 million in Georgia in a B-class area. So I'm paying $13,000 a unit. I bought them all. I'm putting another $15,000 a unit into them. So I'm going to be all in for, like I said, around $32,000 a unit. It's around, with carrying costs and everything, I'm in for like $24 million. And once they're all stabilized, though, in about 18 months, we expect it to appraise somewhere in the $41 to $43 million range. And the bank will give us an 80% loan on that, which means I'll be able to pull around $32 million off the table. And my current debt is $24 million. So I'm going to be able to pay off that current debt, and then I still have a spread of $8 million in loan proceeds, which are non-taxable.
It goes where?
What's that?
And it goes where?
It goes in my pocket.
It doesn't. Some of it doesn't go to. You have equity partners. Tell us how that works? Like, you have other partners in the deal.
Yeah. So I have other partners. I have joint venture partners. I have some investors, but I don't give up a bunch of equity to my equity investors. I pay them a fixed return.
Gotcha.
All the money's in play regardless of the performance of the property, and then they get a little equity kicker on the back end.
Gotcha.
And they like that. They like that better. They like knowing how much they're going to be making on the property or on their investment, and then they like having the little equity kicker on the back end. So, they might get 10% of that. My joint venture partner will get a portion of it, and I'm going to get a big portion of it. So it's non-taxable. It goes in my pocket. I can go and reinvest in another deal if I want to, or I can sit on it, just be super liquid, wait for the market to shift, and go buy things for pennies on the dollar because I'm super bankable at that time.
So I'm doing the exact same thing with like 2 less zeros at the end.
Dude, all you got to do is add some zeros. That's it. People think it's so complicated. Like, how do you create a 200-unit apartment building? You go and look at one unit and figure out what it's going to cost to do one unit, and you multiply it by 200. That's what you do.
All right, Tim.
There's mechanicals and common areas and amenities centers and all that kind of stuff that goes into it too. But the reality is, you look at one unit and you multiply it out by 200, and that's what the cost is going to be to renovate a 200-unit apartment complex.
Awesome stuff, Tim. I want to get to a couple other things. I want to talk about lenders, equity partners, bringing in, maybe just briefly talk about private raising capital and stuff like that. But you mentioned something a second ago. You mentioned you're kind of targeting value add properties. That's kind of your target. First of all, for the people that don't know, what is value add? But secondly, because you alluded to it a second ago, you're talking about how, you wait for the market to, kind of turn a little bit to where you can, you want to be super liquid and bankable and go out and get as much as you want. And then you also said there are deals everywhere, which I agree with that. There are deals everywhere. They're harder to find, but there are deals everywhere. How do you combine those two things? First of all, what is value add? And then how do you find these, the value, you're talking about this value add stuff. Is this just not the right time to be buying apartments? It's what I hear from everybody.
So I think it's like anything. I think there's deals in any market as long as you're targeting wholesale price deals. You can still buy in a hot market right now. Mm-hmm. And if you're buying at a low enough cost basis, meaning your all-in price is going to be low enough where dude, it's just like single family. Right now, you can still make money in single family if you're buying and you're all in for 65 cents on the dollar of what the after repair value is, right? That's most people's formula.
Correct. I guess my question, and I'm with you. I'm making the correlation. It's just a few extra zeros. I get that. I understand where you're going, but with a buy and hold versus a single, like right now, a single family buy and hold is tough. Just, you don't know if we're at the top of the market. We're at all-time high prices, especially in our area anyway. You're at all-time high prices. The rents are at all-time highs. If there's a little correction in the market, the rents are going to dip. Everything's going to dip. How do you hedge against that?
Sure. A couple ways. One is I only buy in B-class areas. I don't build new construction. I think what's going to get hit hard is the luxury apartment realm. Those guys are all paying top dollar because construction's so expensive. The only thing you can do is luxury apartments. And because they're all in at a 6% cap rate, 6% return on investment, interest rates are 5%, so there's not a lot of gap there, especially with short-term financing where in 5 years, if they have to refinance and interest rates are higher and the economy comes down a little bit, they're not going to be able to refinance. They're not going to be able to sell the property. So I see a lot of that defaulting over the next 5-6 years. So that's the stuff that I'm going to buy for pennies on the dollar. That's new construction. And because I'm going to buy it at a lower cost basis than what they're into it for, I'm going to be able to rent it out at a lower price point and attract good tenants and still be able to do that. So that's one thing I'm looking for. But in order to, so I'm staying in a B class area. B class, I think in a good economy, everybody can afford B class. In a bad economy, those A class renters move into B class apartments. Mm-hmm. So you're pretty much always filled up. The other thing is, my model is to force appreciation. Do the renovation, do the value add, the renovations to the property in order to increase the income, decrease the expenses, and that increases the value of the property because the net income is higher. Following me on that?
Totally.
So because I'm forcing the appreciation and I'm not waiting over many, many years for that appreciation, I'm able to create, just like you do with single family, I'm all in for 70 cents on the dollar, and now it's worth $10 million. I'm all in for $7 million. The bank will give me an 80% loan-to-value loan on that. So I'm able to take out $8 million, pay off my short-term debt, and now I have long-term debt in place, meaning it's a 10-year to 12-year term.
Got it.
And it doesn't matter if you bought properties in 2006. If you had a 10-year term loan on that and you went through the Great Recession, the economy charged back by 2016, right? So if you have long-term debt in place, and I don't get variable interest rates, I get a fixed interest rate. So it's steady, predictable. I know exactly what my debt service is for the next 10, 12 years. That's a way that I can force appreciation, create a big cushion of equity in my deals. And then I put long-term debt, fixed interest debt in place for the next 12 years. And then I can ride out any storm. And I'm in B-class areas, so I'm not going to fluctuate like a lot of the A-class stuff will.
Right.
Or even the C-class stuff. The C-class stuff will still fluctuate too because those are the people who are going to, they lose their jobs pretty quick as well. Or, if things shift at all, they can't make their payment on their rent. So I like the B-class stuff. That's what I stick to. And we're pretty good at managing it.
Yeah.
And that's going to build my balance sheet. I'm able to take a bunch of equity out on the refinance in the next 12, 18 months whenever I do those refinances. And right now, as I'm going through it. And that's going to create the liquidity for me long-term, be able to go and buy the stuff in the next couple of years when the economy does shift.
I like that. I like the B class stuff. The temptation for a lot of maybe newer investors is to go after the C and D class stuff because it's just a little bit cheaper. It's in my price range kind of thing. And it's just not the wise thing to do. It's almost like you'd rather get fewer doors in a B class area than more doors in a C or a D.
Yeah, what I found in the C and D class is that on paper, it looks super sexy. Mm-hmm. Looks good. Yeah, I'm making 15% returns, 20% returns on this. What it doesn't tell you is they're still underwriting the deal with like a B class vacancy rate. So, 5% vacancy. Yeah, those numbers are great. The issue is in C class and D class, your vacancy rate is going to be 15 to 30%. And so when you calculate that in, like those tenants only average 6 to 8 months in a property. And then they gotta go because they can't pay rent or they're milking the system, their job changes, they get a flat tire, and they don't have any extra income in order to cover their rent and cover those expenses. And so whenever something like that happens, your vacancy rate will skyrocket. And the reality is if you have nice B-class units with lower turnover, you're going to outperform C and D class properties all day, every day.
It's awesome. I love that. I made the mistake when I first got in this business because like the temptation's there. And I
started out there too, man. And you can make money in C and D class if you're buying for pennies on the dollar. If you're buying at a deep, deep discount, if you're always buying wholesale, you can do that, but you don't want to be caught with that property when the music stops.
Totally.
When the economy shifts and you're stuck with a C or D class, like all of your time is going to be consumed in managing that property, and there's not scale to it. There's a lot more scale in A and B class properties because it's good tenants with good jobs, with good income, that are qualified, that don't want to screw up their credit. So they're making payments every single month. It's a lot less property management in that standpoint versus always having to like chase after tenants, show up in eviction court and do all that stuff in the C and D class stuff.
And I'd never heard someone articulate the vacancy rate like you just said, that the vacancy rate's 15 to 30%. And no one talks about that. And it's totally true. It's totally true. Before we go, Tim, great stuff so far. Before we go, I do want to talk about raising capital. Just talk about for a second, before we maybe talk about how to raise private capital, the difference between maybe like an equity partner and maybe just, you're saying you just pay a fixed rate to your investors. Like, and you also said in the very beginning that when you're kind of new at this, you were giving up a lot more equity just to be able to do the deal. Just kind of talk about that. Someone maybe that's getting started, how they might be able to approach somebody like that.
Yeah. So, all right. So there's two ways to raise money for apartment buildings. One is the traditional syndication model. That's not the model that I use. Typically what happens is the investors get a certain amount of equity in the deal, usually a lot, usually 60 to 80% of the deal will go to the investors who are putting up the cash. But they only get paid if the property is performing. If the property doesn't perform, they don't get paid. So the operator who has the remaining 20 to 40% equity in the deal, they'll get an acquisition fee. They'll get an asset management fee, regardless of whether the property is performing or not. So the issue with that is that interests are not aligned. You're not going down the road in the same way. You're sitting across the table from the investors versus on the same side of the table working together to get the property where it needs to be. Because the operator is getting paid regardless and the investor is not getting paid regardless. Make sense? So go ahead.
It does, but it does make sense. But I always thought it, I guess, backwards that the interests are aligned because each party has equity.
Yeah, but it's really they both have equity, but the investors aren't getting paid unless the property is performing. The operator is getting paid regardless of the property.
But as the operator, I want it to perform because I still have that little equity piece, right?
Sometimes, but you don't really care. It's like a property management company. If you have a property management company handling your property, they're getting paid whether the property is performing or not performing.
But they don't have equity.
Yeah, but still, I mean, they're getting fees. And gotcha. Same thing with an operator. The operator still gets fees.
Gotcha.
So even if the property is not performing, they're still taking fees. If the property is performing, they're taking fees and getting some equity. So yeah, they make a little bit more money, but they're not as motivated as if they were only getting paid from only equity in the deal.
Sure.
So the way that I've structured my deals is I only get paid if the property's performing. The investors get paid regardless of the property's performance. So mine's completely opposite. I flip the whole thing around. So the investors are happy regardless of what's going on with the property. But now me as the operator, as the decision maker, as the managing member of that LLC, I want to get this thing performing as soon as possible because I only get paid once the refinance takes place. And once the refinance takes place, that's when all my investors get their money back. So now our interests are aligned. We're going down the road in the same car, in the same direction. And we all want to get this thing stabilized and refinance as soon as possible because that's when Tim makes my money. That's when the investors get their money back. And then they keep a little bit of equity in perpetuity.
The way I've heard it, and that's a great model. The way I've heard it is in that scenario is they don't, the investor that just put up is just getting a certain return, right? They're just getting a certain rate of return on their money. You're on the hook, right? You're on the hook for everything.
Mm-hmm. Yeah. And I think I should be. I don't think it's fair to the investor if I'm not. If they're going to put up all the cash. Yeah, I'm on the line for the loan. I'm on the line for their cash. Like it's in my best interest to get this thing stabilized and to get it refinanced.
Sure.
Because then interests are aligned. So is that good business practice? Maybe not. Maybe I'm risking I'm putting more of my personal risk or more of my personal wealth at risk because of it. But because I do that, interests are aligned. It's easy for me to raise a lot of capital because people realize that the way that this is structured is by getting the property performing and getting all the investors their money back at the time of the refinance.
So if I'm brand new, Tim, and I want to start doing something like this, and I've got a ton of money out there, I've built relationships over time, and I've got the money's out there. I just need to kind of put it all together and put the deal together. I've got a deal. What do you advise to someone who's brand new, never done a multifamily deal? Because you're okay with putting it all on you because you've got the experience now. But in the beginning, it sounded to me like the story you told in the very beginning. It sounded to me like you were giving up a lot more equity because I guess maybe you didn't have the experience. Is that what it was?
Yeah, because I was newer. No, I mean, if you're good at, you're saying you can raise money, but you don't maybe necessarily have the experience in apartment buildings.
No experience, and I have no money. But I'm putting up, but I've got great relationships. I can raise the money, and I found a great deal.
Yeah, I mean, I would bring on somebody who has experience in commercial real estate.
Give them some equity.
And I'd give them some equity and ask them to just mentor you and coach you through the whole thing. You won't have to give up a lot of equity. If you're raising all the money and you are handling all the operations, you're finding the deal and doing all that, you're not going to have to give up a lot of equity, but it's worth giving up, I don't know, 10, 20% to somebody to come in and just consult with you.
Sure.
Based on, and the way the consultant should get paid is based on the property's performance too. I wouldn't pay them a fee. I'd give them equity in the deal so that way they're invested and they're, again, aligned with your interests in getting this thing occupied and stabilized as soon as possible because that's when they're going to get paid too. So that's what I would do. I would call up, dude, call me. I'll sponsor any deals. I'm sure Corey Peterson, I know any of these guys would. I'd be happy to get involved in deals and coach you through any sort of project. I can raise money. I can bring the financing. I can do anything, any aspect that you need me to do or do as little. It's a la carte. However much you need me or not need me, I'm willing to get involved in deals. So
awesome.
I do the coaching and stuff, but that's transactional. The only reason that I do the coaching is so that I can do more deals. So I have more deal flow so I can raise more capital.
Totally.
Because I'm in this thing for the long haul. I want to build legacy wealth by acquiring as much property as possible.
Tim Bratz, awesome stuff, man. Incredible stuff. How can people reach out to you if they want to get to know you a little bit better? How can they get to see what you're up to?
Yeah, I mean, absolutely. Facebook is awesome. Obviously, that's how we met. It's pretty powerful, social media and the connections you can make on there.
Totally.
So Facebook, hit me up, Tim Bratz. You can, I'm sure Brian will share my contact information there. You can go to my website, CLETURNKEY.com. CLEturnkey.com is my investment website. And then, yeah, I mean, I do some coaching and stuff too. I have seminars and 3-day training events on how I take the complicated realm of commercial real estate and simplify it and make it third grade level so anybody can do it from A to Z. And then, I do a lot of deals with my students as well. So if you guys want to come out to that, go to commercialempire.com and you can fill out the application on there. My team will reach out to you and get you some details on that. But dude, I appreciate you having me. This is awesome. You're creating a ton of value, ton of content, and just keep doing what you're doing, man. You're changing lives. So I appreciate you, Brian.
Thank you. I appreciate you saying that. Guys, go follow Tim on Facebook. It is so encouraging. I just watched your Facebook Live from the other day where you're in Warren Robins, Georgia, and just like talking about the deal, and it's just like, what am I doing? What am I doing with all this single family stuff? Man, I'm like, I've been in this for like 6 years, 7 years now. I gotta go more towards the commercial stuff. So it's just inspiring to see that kind of stuff. So guys, go follow Tim and just see what he's up to. And he posts the numbers. It's just really encouraging. I want a t-shirt. How do I get that t-shirt? That's an awesome shirt.
I'll send it over to you, bro.
Are you serious?
Offline, send me your mailing address. I'll get it in the mail tomorrow.
That's an awesome shirt. I love it. Guys, we love you so much. Hit that subscribe button. We'll see you next time.